Good morning or good evening to everybody who's joining this StoneX's post FOMC call for September. Welcome and thanks for making the time to join us. We have Kathryn Rooney Vera, who's StoneX's Chief Market Strategist, and Stephen Gola, who heads up our U.S. sales and trading business, both calling from the New York time zone. So thanks for making the time. Subsequent to their speeches, we'll have a brief Q&A session to make this call more interactive. You can submit your questions using the Q&A panel or through your salesperson here at StoneX. So on that note, Kathryn, please take it away.
Good morning, everyone. I'm going to share my screen here so that you can see some of the visuals that I will be going through today. But I think it's important to kick off with what is the elephant in the room, which is the Fed's dot plot and the summary of economic projections, which you can see here. I think the most interesting thing from my perspective, and not to get too academic, but is where the Federal Reserve sees R star, which is the neutral rate. John Taylor has been very famous about basically saying it's 0.5%, but if you look at the longer run range, there's somebody on the FOMC board who thinks that it's 3.8%. So that calls my attention. That's probably the one thing that jumped out to me, which was perhaps different from what everyone else was looking at. So certainly a ways away from what the let's call pre-crisis R star might have been, which is the neutral rate. Of course, what everyone is talking about is the retracement of the 50 basis points from the 100 basis points that the Fed had in the dots plot in June, estimated that Fed funds would drop next year. So instead of a 100 basis point cut, now the dots plot indicates a 50 basis point cut. In my opinion, and I'll get into this a little bit more, but this summary of economic projections is a soft landing. This is the Fed's base case. No matter what they say, what they've laid out here is a soft landing or a no landing, depending on how you define each. Basically, what this says is that GDP is revised to the upside this year, with inflation revised to the downside. Minimal, insignificant increase in the unemployment rate expected for next year. In fact, that estimate for unemployment was dropped for 2024. And that's very important because the Saum rule from Claudia Saum, and I like this rule. Basically, it says 50 basis points upside move in unemployment over the course of 12 months compared to its 12-month moving average always means an economy is already in recession. And if the Fed is right on their unemployment rate forecast for next year, there is no recession. And if the current trajectory continues, this disinflationary trend in an environment of full employment, de facto full employment, then that is the definition of a soft landing. And that is the Fed's goal, but it's also their base case. I think what the markets have been reacting to across the board in every asset class, from equities to fixed income to Forex to commodities, has been let's call it the reassessment of what the Fed is going to do going into next year. So the market has been kind of pushing the Fed to cut rates. The Fed pushed back saying, when we say higher for longer, we actually mean it. Because remember back in June, the thesis was, or they were explicitly saying higher for longer. Then you look at the dots and it's showing a median of 100 basis points in drops. And here's exactly what I'm referring to. I think one thing that perhaps I can add to what most people are already saying, so as to be slightly different, is that one thing that most are not considering is the electoral impact. And I think that perhaps, as Robert was saying, a lot of the clients in this webinar are keen on talking a bit about that. And I think it does come into play with the Federal Reserve. The Fed, from my sources, would love nothing else than to get off of the headlines, get out of the mouths of everybody on Capitol Hill, and just kind of fade into the background. So I think it shouldn't be a surprise that the Fed has taken down from 100 to 50 basis points their projections for rate cuts next year. They've been saying for weeks that they intend to keep rates high, but nor do they want to precipitate a recession just before just before the election. So if they don't cut from now through year end, that's one less cut that they're going. If they don't hike another time from now through year end, that's one fewer cut that they can make next year. Skipping another rate hike this year reduces the odds of that recession. And I mean, yes, it's only one more, but my idea has changed. I used to think that they would hike once more November, December, but I think the combination of an imminent government shutdown, which I think is going to happen, the resumption of the student loan crisis or repayment, and the oil price surge is probably going to give the Fed pause, so as not to induce a recession just before the election. But a lot can go wrong. And what I would say, and what I have been saying for a very long time, and I think that the market is catching up to this idea, is that the market had been discounting with too great a probability the soft landing thesis, and too great a probability that the Fed could actually cut 100 basis points or more in an environment where inflation is still above target. As you can see here, wage growth is certainly decelerating, and that's a good thing. But to get to the 2% or to equilibrate to 2%, wage growth has to be even lower. The fiscal deficit is enormous. It's about 8.5% of GDP. This is a supply issue for the Treasury market in a structural way. And then one thing I wanted to mention, and I'll finish with these two slides, is that there's a real risk of re-acceleration in inflation next year, and not for just the reasons that one can assume. For example, oil prices and perhaps topping 100, and the pain at the pump. But there's a real risk of re-acceleration because from my perspective, and I've said this for many months now, soft landing or no landing is not consistent with the 2% attainment. So we can talk about whether 2.5 is fine or 2.8, but it's not consistent with a 2% inflation target. So the Fed is going to have to choose, either change implicitly or explicitly its 2% target, or as Steve Gola coined the term, and I love it, and I've been using it like crazy, break something. And that break something would unfortunately require a contraction in aggregate demand, which is a recession. I put this chart up here because I think it's important that we realize that a reacceleration of inflation can occur, and in fact is occurring. You see it in Canada and you see it in the world economy weighted inflation. And just to finalize my initial comments is when I look at the StoneX fair value models, and I think about where treasuries should be trading, you look at fair value, and fair value for the US 10-year treasury is significantly lower in terms of yield. I think that where we are right now, 4.5, is probably an attractive entry point. I think that, and I think Steve agrees with this. We talked a little bit earlier that probably by year end we'll see some retracement in yields to 420, 425, and then we should expect them to drop even further. They could crack 4 and to the downside even to 380 over the next 6 months if economic principles hold. Now this time could be different, but likely it is not. And with that, I'll pass it to Steve.
Thank you, Kathryn, and good morning, everyone. Thanks for joining. Give me 1 second. I'm going to try to share my screen now. Okay, I hope everyone can see that. I'm also going to try to not be redundant in a lot of what Kathryn went over there. Of course, I'll provide some of my own observations as well. We're starting off with just kind of a look at the year, a very quick look at the year. And it's been interesting for sure. Interesting for a lot of reasons. Maybe most of all in that, and this is a little bit unconventional for a hiking cycle, but in this year specifically, in 2023, where the funds rate has moved up 100 basis points from 5 3/8. Typically in prior cycles, certainly the movement along the curve would be, at least along the benchmark curve, would be driven by the front end. And actually, as it turns out in this case, we've actually seen, some, albeit small, but some amount of steepening. The 10-year duration is actually up 100 basis points as well during the course of this year. Also interesting throughout the year, because there's been a lot of starts and stops. There's been 2 pauses at this point. We've had a series of hawkish pauses and dovish hikes, etc. A variety of phrases going through over the course of the year. From ongoing hikes to hikes may be appropriate. A lot of talk about restrictive and data dependency, and most recently moving towards the proceeding carefully. Still a data dependent Fed that I do believe. More so than the past, there's been some amount of humility coming from the Fed. I think Powell essentially admitted that for the last several years, their estimation of R star was essentially wrong. And I mean, that's obvious, I think, in the inflation that we're enduring at this point. Moving on to yesterday and what was said and some of the dots, and again, I'll try not to be redundant. I do think that the 23 and 24 dots moving up 50 basis points, shouldn't have been and almost couldn't have been a surprise to most people. Based on third quarter estimates for GDP, certainly the 2023 GDP is significantly higher, and it went up almost a full percentage point, or maybe a full percentage point. But the wild cards were going to be, what does 2026 look like? It's the first time every September we get the first, subsequent year in dots. And then would there be any change in the long-term dot? Talking about the long-term dot, the median didn't change, but it's worth noting that the highest 5 moved up dramatically from an average of those that were above the 2.5% estimation for long-term moved up, and their average changed almost 308, 345. So that was a significant jump, even if the median didn't move. And then looking at 2026, there's a 2.70s median, which is a significant, we'll call it eases from 2024 to 2025. But really a third of the respondents had their estimate for a funds rate, if not 100 basis points, 200 basis points higher. So I think those things in particular surprised the market. 26 was always going to be an X factor, while the long-term dot itself didn't move. Some of those numbers did. Looking at the market movement, I mean, the biggest movements obviously were further out the curve. It's interesting that this was, in a hawkish scenario, this was led by the back end of the curve. 30s over the last 2 days are up 15 basis points, and 2s have moved up 5. Looking also at Fed funds futures for end of 24 and end of 25, those only cheapened 6 basis points. So this is really led by the back end, and for that reason, the curve, you could make an argument or make an interpretation that this was kind of a dovish meeting, that they're not doing enough and they may never solve the inflation problem. What I found interesting though is that break evens, front end break evens, even in a higher oil complex, were 6 basis points, 6 basis points narrower. And anytime break even is narrow or real yields lead sell-offs, that's always perceived as a hawkish Fed. So a little bit of a mixed interpretation there. And it's challenging to discern exactly what the market is thinking in that regard. Moving on to policy, rationale. Why are they doing this? Why are they not hiking when presumably inflation is not solved? Probably a handful of reasons could be the answer, and I'll provide a few of what I think. Though I'll also say that I've personally replaced the higher for longer phrasing to a longer instead of higher. So maybe that's mincing words, but it seems clear that the Fed doesn't necessarily want to hike or hike dramatically from here. A lot of reasons this could be the case. There could be a logistical reason. Dissension in the Fed. It's pretty clear looking in particular, I think, at the 2025 dots. There is 300 basis points of range between the lowest dot and the highest dot. And a lot is dispersion in between. So there's clear dissension among respondents, and so to get any kind of consensus for these meetings is a real challenge. Could be one reason why they're not they're not hiking much further. Two, they very well probably do believe that they are in restrictive territory. Obviously, that's a relative term, but we'll look at this chart, and this chart goes back to the early 1990s using core PCE to try to estimate the real funds rate. We're currently without a hike at this past meeting. We're currently at a real funds rate of about plus 125. Mind you, we came from minus 500 or 600 area not that long ago, which exceeds the 2018 peak. We probably have really another 150 basis points to get to the 2006-7. I'm not sure that's a time period anyone wants to get to, least of all the Fed. But we're gonna move in that direction fairly quickly still if the Fed hikes again and inflation or core inflation at least continues to dip as it has for I think the last year at least. Other discussions as to why they're not hiking when perhaps they should. Certainly for at least a decade, if not two now, there is an ingrained bias among maybe all central bankers, but certainly the Fed to keep rates, keep things relatively accommodative, to not break things. At first, I haven't fully kind of investigated this element of keeping rates on hold, but they've now introduced this idea of the supply side dynamic of restrictive or trying to prevent inflation. And one way is of course demand destruction, but now their discussion about attacking it from the supply side and trying to ensure there's enough production in the economy that we're not short production relative to demand. And doing that by not breaking things is an interest that's entered the lexicon of the Fed lately, and could be very legitimate. So it's hard for me to tell in that regard whether that's an excuse based on their bias or whether that's a real legitimate concern and a strategy for maintaining or trying to reduce price pressures. See, and I've thought about this for a little while. But humility, and it's not a word I've used for the Fed in many years. But there could be, certainly, they had their tail between their legs throughout 2021, and inflation was proving them wrong for so long. But if you think back to the QE period, the Fed was insistent that they could create inflation, and they were insistent they could create it, and they could do it by buying more and more assets. And the reality is that by itself never did it. And so they may have come to the conclusion that they are not all powerful, and simply pushing rates higher and higher still may not necessarily solve the problem, and certainly goes against their supply side argument of late. So there may be some humility on the Fed's part, and really just a hope that they don't have to break something and the economy can do the work for them. On that note, I put this slide together. I put it together a little while ago, but it looks back at I think the last 30 or 40 years. The Fed can ask themselves the question is, who's more powerful in terms of reducing price pressures in the economy, inflation, and is it the Fed or is it necessarily the economy itself? From the Fed's perspective, what I did here is I took a look at many hiking cycles. There's really only four significant ones dating back to the early 90s. And, wanted to see what did those hiking cycles do to PCE, to inflation pressures. And I found it really interesting that, and I'll direct you to the kind of middle of that pink grid with the row called PCE. I found it really interesting that if you look at the cycles in 1999, 2000, 04 to 06, and then 16 to 18, the subsequent effect or the subsequent moves in PCE after these hiking campaigns was actually a higher PCE in the subsequent 6 months. It was only in 1994, 95 when they hiked at a much faster pace. Did PCE fall in the subsequent 6 months. This cycle, at first, they hiked at more of a 33 basis point per month pace. So you could argue for sure they're gonna reduce inflation by that much. Realistically, they already have, but now they're entering the point in the cycle where they wouldn't be moving at 25 or 30 basis points per month. So almost what good is it? So there, as I said, there may be some humility in their decision making. The comparison I chose is looking at the economy itself, and there's not a lot of very granular or weekly data you can look at to kind of get a gauge of the economy. But I did use jobless claims. It's obviously got a rich history, and it comes out weekly. And what the table on the bottom looks at is it compares current jobless claim numbers to the lowest number in the prior 52 weeks. So obviously, as jobless claims are rising, they might rise by 5% or 10%, or 15 or 20, et cetera, versus the lows of those last 52 weeks. And what is that? And obviously, the more jobless claims is rising, the more difficult a time the economy is having. And what does that do to core PCE? And you can see on the bottom that the greater the increase in jobless claims, and the more the economy is hurting, it seems the more PCE comes down subsequently. It's interesting in the data, and that data goes back to 1987. Interesting in the data that when jobless claims really spikes, you don't get the same core PCE decline. I think a lot of that has to do with during those periods, the Fed has been extremely accommodative in the past. I'm not sure that'll necessarily be the case going forward. My last slide is how to position around this, and as Kathryn said, there's definitely going to be some headwinds going forward. The Fed certainly has painted themselves a perfect landing. Obviously, the momentum is lower, not just this past week, but over the last few months, and that's been related to obviously repricing of the floor and rates when we look out a few years ahead as the Fed may eventually cut. But from my perspective and thinking about the markets from my trader hat and a risk reward perspective, I do think you're entering the buy zone. You're close. And there's a lot of reasons for that. You can compare this cycle to many in the past, and really, the peak in interest rates is typically, almost, within 20 days in each instance of the last hike. And I think we're almost there. Certainly, this cycle may be different, may not be that easy, but historically, there's a tailwind there. From a valuation perspective, the market has moved a lot. And we've been watching it versus terminal Fed funds. And in this case, I'm talking about terminal on the high side. What is the peak in the Fed funds rate? And a few months back, you had twos trading 110, 100 through terminal Fed funds. Tens were trading, 180 basis points through. And we're obviously, at the cheapest level relative to terminal that we've been at any point, terminal minus 30 basis points. Then when I think about where the longer pricing is as well, this floor on Fed funds, after the Fed eventually begins easing, it's currently, as far out as you want to look, the floor is 3.85% right now. I don't know if the Fed, and that goes out for 5 years plus, and I don't know if the Fed will get down to 2%. But even if they make it to 2.5%, which I think is a reasonable best guess, 385, implies a real Fed funds rate of 100 and almost 150 basis points. Obviously that real funds rate was negative. The R star they had been talking about was almost zero. If you look at the long-term dots versus, their inflation goals, you can argue the R star is closer to 60 or 75. And so those numbers at plus 150, they look appealing. I don't know that you're going to sustain, let's say 200 plus without having some hiccup. In the argument for being interested in longs, I also point out a demand destruction option. Kathryn also mentioned, higher energy prices. A lot of people talk about energy prices being inflationary, but historically, it is absolutely a tax on the consumer, especially those who use it. And it definitely dents consumer confidence, and so that's real at the moment. May become even more real. I think the number of days of oil in reserve in the United States right now is the lowest on record. as a historical low. So this is a real threat to demand in the, I'll say months ahead. I don't want to say days or weeks, but months ahead. And then I'd also point out the kind of evaluation of the equity markets versus the bond markets at this point. And this is a risk for equities, and which would always be a boon for fixed income. But this scatter plot I have here is essentially and this goes back really only to 2009. It's the S&P's yield relative to the treasury yield. And right now the S&P's yield is essentially as low as it's been versus 10s at any point since 2009. We are at the point where we're left of that red line, and the returns, the 6-month forward returns on equities during those periods have not been good. There's only one dot of a few, I would call it a dozen, that doesn't have negative returns 6 months forward. So between gasoline potentially being a tax, wealth effect destruction potentially in equity markets, that's certainly something that would create more interest in fixed income. Kind of pinpointing either timing and structure, I'll point to the front end. You can say 2-year notes, you can say 5-year notes, depends on your risk appetite. I say the front end because I do believe the Fed is your friend. They're not eager to be hiking rates. They're really not eager to be hiking rates again. I'd also point out that clearly at this point it is the low vol sector, and it's the low vol sector because, well, frankly, the Fed is probably not want to move quickly in one direction or the other. I also like the front end because it's frankly higher yield, less negative carry. And if you don't believe the Fed is easing either dramatically, I would say especially dramatically, well, I'd much rather take the carry or the higher yields. Timing wise, as Kathryn said too, there are some risks ahead. Obviously, inflation has been trending lower. JOLTS trends certainly pointing to a looser labor market. But again, those things take time to play out and for the market to focus on them and bring out that word recession again. Nobody's really talked about it, but these things do run in cycles. In terms of any long and being long on the front end, listen, I think where do you win? Certainly you win in a steep easing environment. I don't think that's necessarily the case, but front end always performs best. I think in a subtle ease, you could argue that the Fed may still not solve inflation, and so term premium remains out the curve. And in no ease scenario, I think the back end certainly could perform the worst. And then obviously the losing scenario is, I would say if core CPI starts to run, it's down at 4.2. If it starts to run, 4.6 or greater, and starts to return higher on a core basis, that would certainly, I think create action from the Fed. So still, I think the front end is the best bet at this point. If you were interested in some duration, I'd move it out to 5s, otherwise the front end. But those are my views, how we're positioning and what we like and how we see it. I'm happy to answer any questions.
Okay, great, Steve. Thanks very much, especially your trader hat positioning bias. We have a couple of questions. Hopefully, we can squeeze through them. This one's probably for Kathryn concerning the oil prices, given the recent sharp uprise, how it's going to impact inflation. It's relevant for Asia, given it's a largely oil importing region, and how this might influence Fed's decision making, especially in 2024.
Well, oil prices are the reason that headline moved or came higher than the market had expected. And the fact is that oil prices do flow through into core with a delay. So even though core strips out food and oil, core PCE does feel the impact of a jump in oil prices, such as what we have seen in recent weeks. So if we see oil move higher or stay higher, I did an economic analysis in my last position, and my conclusions were interesting. I remember if oil prices move, every $20 or $25 move sheds I think it was 0.6 percentage points off of GDP, 0.4, 0.6. So you would get a stagflationary scenario, meaning high inflation and a hit on growth. So I think that if we get a scenario, and I think Steve kind of finished his spiel talking about where the Fed might act again. We're at 4.2. I have my core PCE inflation forecasts have 3.6 by year end, so on target with what the Fed has adjusted downwards to. So I do think we probably get there this year. But then going into next year, a soft landing or no landing, which is what the Fed is kind of banking on. That's their base case scenario, combined with high oil prices. In my view, I'm going to be shocking my inflation models to the upside, and I think that that would cause a reacceleration in inflation. And what I've said for some time and have been pretty out of consensus is that the Fed, there's a very good chance the Fed doesn't cut at all next year. And I think that this retracement in the asset classes is beginning to bake that into the possibilities when beforehand it was not baked in at all. So I think that's a real risk. And in fact, I would go so far as if core PCE is sticky around 4% or higher next year, the Fed hikes. The Fed has a credibility issue. And if they were to cut when core PCE is, in my view, 3% or higher, I think it would take a serious hit. They've already had several hits. So I think they would probably hike at least one more time. And with that, I'll turn it back to you, Robert.
Okay, great. Thanks very much for that insight, Kathryn. We have time for one last question. One of the listeners asking, general U.S. economy at large, post this Fed hiking this year especially, how's it impacting the housing prices and rent prices across the board, especially post the higher mortgage rates as a result of the Fed hikes?
Well, I'll jump in with my 2 cents on that. The ZIRP policy, the zero interest rate policy, caused a lot of distortions in the market, and one of them is in housing. So 92% of all homeowners, including myself, I can't speak for Steve, but including myself, have locked in a rate below 5%. And if I remember correctly, I think it was 62% under 4. So people aren't selling their houses. There's a massive shortage there. So even though the housing market, which is 40% of headline and 30% of core PCE, in terms of rents and in terms of housing home prices, even though that is has the most direct impact from rate hikes, you have not really seen any impact there whatsoever. And I think it's going to be tough to see that be meaningful in terms of a deceleration there with the current scenario. So there are big distortions, and I think that the lack of reaction from the housing market has disappointed the Fed. And I think that the combination of rising healthcare costs, rising oil prices, a fiscal deficit of 8.5% of GDP, an election year coming up, my suspicion is that inflation is not going to miraculously retrace to 2% when 75% of core PCE is driven by service sector inflation and the consumer confidence is still remarkably high. So you have to get unemployment to move higher to change habits of consumption. I said this in our last meeting, but it's my conviction view. The US consumer continues to consume until and unless they no longer have a job. And then habits of consumption change. And until then, I think inflation remains steadily above 2%. At what point does the Fed feel comfortable cutting? Well, I think that's not a specific number, but we would have to see a broad-based decline in inflation, starting with, but not exclusive to, a decrease in service sector inflation, which includes housing. Mm-hmm.
Thank you, Kathryn. Any final parting words from you, Steve?
Well, she answered the housing question way better than I could have, but I'll just say I enjoyed preparing for this and speaking to everybody, and I appreciate everyone listening to Kathryn and ourselves and joining.
Okay, great. Thank you very much, Kathryn and Stephen, for joining the panel, and thank you everyone for dialing in. We look forward to hosting you on our next StoneX call. Have a good day, everyone. Good evening, Stephen and Kathryn.
Thank you.
Kathryn.
Have a good day.
Thank you. Thanks all. Good night. Goodbye.